Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, June 8th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas that we feel offer the best prospects for growth as opposed to trying to time the market. We focus exclusively on the traditional investments of stocks, bonds, and cash, so we analyze fluctuations in the stock market as well as interest rates to help our overall investment decision process. So we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. The stock market went up for 9 weeks in a row, and over that period of time gained over 19%, which is very unusual. It's one of the best 2-month periods we have ever seen in the history of the stock market. So, as cliche as it may sound, it was a very unusual period. We were unable to achieve 10 weeks of gains. We did have a drop off here at the end of this last week. But for the 2-week period, we had a decline of 0.83%, and we have a year-to-date gain of 7.86%. Again, if we look at a 6-month chart, we were kind of just bouncing around here toward the end of last year, beginning of this year. We had the war with Iran start here at the end of February, and we had a drop off on the market. But from March 30th, when the ceasefire was declared and we were no longer dropping bombs in Iran, and we've been trying to work towards more of a diplomatic solution, we had a significant run, right? Over 19% through May 29th, almost 20% if we include the peak that we hit this last week on June 2nd. Obviously, there's no sugarcoating it. This decline at the end of the week is not anything comfortable that we're happy about. But if we put it into perspective, it's still over a 16% gain from where we were at the end of March, right? Still in a 2-month period, 16% is super fantastic. And we're happy that we've been staying invested over that period of time. If we look under the hood and we see what's been driving the stock market rally, I found that we have 10 stocks that went up over 100% over the last 2 months. So from March 30th through May 29th, we had companies like Micron and SanDisk, Intel, like all of these artificial intelligence software chip related names went up triple digits. And that is it's super incredible, right? I mean, we don't usually see this kind of growth in individual names in that kind of period of time. So very interesting. But if we take a look, this is just the performance on Friday. We had some significant declines, right? Same names though: Micron, SanDisk, Intel, Western Digital, all the companies that have done really well over the past 2 months. So, if Micron's up 200%, but then it drops about 13 on Friday, right? I'm like, darn, I'm still up 187% over the last 2 months. Like it's really about perspective. And yes, I don't want to reduce the experience that we had on Friday. It was a very bad day, but in our opinion, it's more of a rebalance. It's more of, hey, we're up 200% on this name. We're going to sell it so that when we start meeting with clients this summer or this fall, we can say, hey, we invested in these companies and we doubled your money in these investments, and then we got out before things started going down a little bit. I mean, it could be as simple as that. And they're rebalancing into some of the names that Clorox, Kimberly-Clark, Allstate, Progressive, Colgate-Palmolive, right? Some of these names that haven't seen the kind of growth that we have in these chip-related stocks over the past 2 months. So yes, Friday was a rough day. We're not overly concerned about it, at least at this point, but definitely something that we're keeping on our radar to see if we need to make any other adjustments going forward. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department, and we'll also look at spreads on high yield corporate bonds. So these are interest rates listed over here on the left. We've got maturity lengths listed down here on the x-axis. So each dot along this graph represents an interest rate for a given maturity date. And the brown line's where we were 2 weeks ago. Green line is where we were on Friday. Not a lot of change, right? I mean, we're talking 4 basis points, 6 basis points. These are very small changes in interest rates, suggesting to us that if we're not seeing big moves in interest rates, um, we're not overly concerned about a 1 day downturn in the stock market. If we start seeing other things happen with interest rates, significant moves in one way or the other, especially if they're going up, that would give us more cause for concern. The 10-year Treasury, it's still in an uptrend for sure. This is where we were back before the Iran war started, below 4%. We're about 4.5 on the 10-year Treasury, which is not a very comfortable position for those that are trying to borrow money. But for those who are investing in fixed income or in money markets, this is a much better rate that we're getting now on that cash than we were just a few months ago. Looking at the spreads, so this is the additional interest that is paid on these corporate bonds for companies that are issuing debt to finance their operations above and beyond what interest rates we're getting on the U.S. Treasuries. And we're looking at spreads that are down where we were before the war even started. So again, we're not seeing any signs of stress for these companies and the interest that they're paying on their loans. So obviously we'll have to wait and see how things shake out. But as of this point, we're very happy that we've had a 16% run in the last 2 months. And we're hoping that Friday was a one-off kind of a day and that we can get back to seeing some growth in the next couple weeks. All right, so what happened on Friday that drove the markets down? Well, a big part of it is the change in non-farm payrolls that came in at 172,000 when we were expecting about half of that. We also had revisions to prior months suggesting that there were more jobs added in March and April. And this is one of those classic good news is bad news type economic data reports. So the economy is doing well, which should be a good sign. But if it does too good, then we get higher inflation, and we need to have higher interest rates in order to try and disincentivize people from spending money and growing to a point where we have inflation that is unsustainable. So because we are looking at an economy that's better than we thought, now that's translating into the potential for higher interest rates in the near future. We're still dealing with higher oil and gas prices, and that's trickling through every other aspect of the economy as well. So things are expensive. We're still spending money, right? Consumer credit came through yesterday afternoon, which nobody really pays that close of attention to, but people are putting more money on their credit cards than we had anticipated. And that could be, you can make a case either way. That's either a good thing or a bad thing. But generally speaking, historically speaking, people are putting money on credit cards when they are anticipating that they will be able to pay it off, even if they're paying it off over time. So if people are not confident in their future, they won't be putting as much on credit cards, which again, we can make a case either way. But anyway, so that's kind of the issues that we were running into yesterday. We also are at the end of first quarter earnings season, and all those companies that have seen triple digit gains or high double digit gains, we're watching those earnings reports very closely, and we're trying to see if they are forecasting the kind of growth that we are needing or wanting in order to keep their stock prices going higher. And so there are some that are giving us cause for concern, or they're having to raise more money to do more build out for artificial intelligence, et cetera. So even though we hit an all-time high at the beginning of the week, we saw a little bit of those cracks starting to form on Wednesday and Thursday, and then obviously Friday, people decided, all right, it's time to get out of some of these names, trim those positions, and do a rebalance. Which again, it's June. We're coming up to the end of the quarter, so it's not something that we're not expecting, I guess. We did talk a little bit last time about how there's a pretty strong correlation between the 2-year U.S. Treasury bond and the Fed funds interest rate. And a lot of times, historically, the 2-year Treasury rate will kind of guide the Fed in which direction they either need to raise the rate or cut the rate. So going back to 2001, first, the Fed funds rate is the white line. The 2-year U.S. Treasury is the blue line, and then these red bars are U.S. recessions overlaid on the chart. So we've got periods of time where there's significant gaps in between what the Fed funds rate and the 2-year Treasury rate are, but you can see that it will either lead it up or lead it down, just depending on what the economy is doing. We're at a point now where the 2-year Treasury is above where the Fed funds rate is, and that has all happened since the end of February when we started the war. We were probably going to get a cut in the March meeting if this hadn't happened. So instead, we've had no change in the last several meetings. President Trump just got his guy, Kevin Warsh, in as the chairman of the Federal Reserve. They're going to have a meeting here on June 17th, and it's widely expected that there will be no change to the rate again. If certain conditions are met, say, I don't know, the end of the Iran war, we get the Strait of Hormuz reopened and we get oil flowing and oil prices come down and gas prices come down, those are disinflationary, and that would naturally lower the 2-year Treasury rate back down below where the Fed funds rate is. And we could resume cutting interest rates, which is what President Trump is looking for anyway. He's been talking about that ever since he got back in office. So we are anticipating that we will get an end to this Iran conflict at some point, which will allow those disinflationary events to happen. And we are not anticipating the Federal Reserve raising rates. So if we can, we've shown this before, and we can pull it up again. We have calculations. So this is called the discounted cash flow formula. And this is one way that we can do a calculation for a stock price or a stock index like the stock market. And we look at future cash flows, usually from dividends that we're receiving from those companies. And we use a discount rate, which if we can, there's the discount rate has its own formula anyway. But if we're looking out into the future and we're trying to figure out how much money are we going to get from investing in the stock market today or in a stock today, and we're looking at the future cash flows, we're using a discount rate, we can come up with a value. And based on the decline that we saw on Friday, we can do our own backdoor analysis of what we're seeing, and calculate roughly a 0.5% increase to the Fed funds rate over the next 12 months is what would cause the stock market to have declined as much as it did on Friday. So again, we're only one opinion out there, but we do not expect the Fed will raise interest rates unless there's something else. Either the Iran war doesn't get resolved or we have other inflationary problems over the next 12 months. We think that the playbook is going to be no change, or we're going to have a resolution to these other issues that will allow the Fed to start cutting rates again. So we've got people out there who've got a lot of money invested. We've got mutual funds, we've got other firms that are doing the investing and pushing these markets around, and they're positioning for different scenarios. And so our scenario is we're going to take advantage of the interest rates, and we're going to put money into those bonds that are paying higher rates, maybe have a little bit more cash in money markets so we can enjoy getting a relatively low risk 4% return. And then we're going to be selective in where we invest in stocks in different areas, both here in the United States as well as in other areas around the world. And so, okay, let me go quickly to Uh, the oil prices still kind of in a downtrend. It's kind of flat. It's not. It's bouncing around, but we've come down from over $110 a barrel to about 90. There are several reasons why oil is not 200 or $300 a barrel. It sounds like a big reason is because China had been building up a reserve and they've cut back on how much they've been purchasing, but the US is exporting a lot. We are seeing more get through the Strait of Hormuz than we're actually reporting. So we've been showing this chart, which was showing about 100 tankers a day on average were getting in and out of the Persian Gulf through the Strait of Hormuz, and that dropped off to basically zero. Well, it turns out that there are people who are trying to figure out how many tankers are getting in and out of the strait by using the transponders on those tankers. And it sounds like we had an article that we just read this yesterday, that nearly 1,000 vessels have been able to get in and out over the last 2 months because they've turned off those transponders so Iran can't detect them and fire upon them. So a couple of very interesting articles. So the government's basically coming out and saying that the Central Command is saying that, hey, we've seen at least 1,000 come in and out. And then another article this morning about why it's not $200 or more. And again, so just very interesting commentary that we've been looking at and realizing that it's not sustainable in the long term. Like we still need a resolution. We still need to get oil flowing, but seeing where a lot of the stuff has been going on over the past few months has been very interesting. So we're no longer going to be looking at this chart because we don't feel like it's accurate. Not until transponders all get turned back on. This is basically going to show too few tankers that are actually getting in and out. U.S. refineries are operating at full capacity, so we're seeing that gas prices are coming down. So we were above 4.50 a gallon, but now we're about 4.19. And it's interesting because here at the beginning of May, we were about 4.43, and at the end of May, 4.32. So even that is a decline in gas prices that will be reflected in the next inflation reports that we get this next week. So we're already starting to see disinflationary events, right? That we can start forecasting what those inflation reports are going to look like based on some of these factors. So again, just very interesting. That's kind of the status of things at the moment, and we're just going to keep our eye on how things are going in the markets, and if things continue to be bad this next week, then we may look to make some other adjustments. But we would not be surprised if maybe Monday, Tuesday things aren't super fantastic, but by the time inflation reports come out Wednesday, Thursday, and they're better than expected, that things turn around and we're back to some growth in the market. All right, for a final word, I feel like I've been rambling on for too long, so I don't want to take a lot of time with this final word. But we just got back from an epic road trip. We did 10 states in 10 days, flew in and out of Philadelphia, went up to Niagara Falls, all the way over to Maine, and then down the coast and back to Philly. So Northeast road trip. And I lived in New Jersey for a couple years. It was about 25 years ago, and we used paper maps to get around. And that was, I mean, that's just 25 years ago. I remember being married and using MapQuest to get from our house to, I think it was up to Bear Lake. And we were driving along I-80 and it had us get off the freeway and then go on some dirt road, and we can't figure out why. But needless to say, it took us way off our path, and then we had to turn around and get back on I-80, which, I mean, again, why it was super weird. But as we were driving through into New York City and some of the bigger cities, like it's very confusing, it's complicated, and we've got Google Maps now, right? And I use Google Maps almost on a daily basis, even if I'm just going to and from the office or to the next town over. I like to see if there's traffic. Is there an accident? Is there a better route for me to take? Which, I mean, can you imagine? These things were just not available 25 years ago. So that kind of technology has come a long way. and I still got lost on Google Maps. It was very confusing and frustrating because there's so many different exits, and you miss the exit, and you're kind of in trouble. And so I end up thinking a lot about Google and Maps, and just with artificial intelligence and with all the technological advancements that we've seen. Um, our lives are going to change again. Like if you think between now and the next 25 years, from education to communication to transportation and healthcare, like every aspect of our lives is going to be touched by artificial intelligence. And we're probably still too early to know, who are the big names going to be in even 10 years. Um, Amazon started off as a company that helped us change the way we read books, and now they have completely changed the way that we shop. So anyway, long story short, our lives are always changing. Artificial intelligence is going to continue to do that. And it's very interesting to see how quickly things change. And we're grateful that we have an opportunity to be in front of this screen on a daily basis, to watch the things that are changing, to try and invest and capture some of that growth as best we can for you. And I look forward to continuing to do it for you for as long as we can, until artificial intelligence maybe puts us out of a job. So hopefully not in the next 10 years, but we'll see. All right, have a good couple weeks, and we'll see you soon.